Welcome back. The Federal Reserve raising interest rates for the third time last month to a range of between 1 and 1.25%. Wall Street had been expecting at least one more rate increase this year. We are expecting that to happen in September. But earlier this week, Federal Reserve Chair Janet Yellen told Congress that the Fed is prepared to scale back on its rate increases should inflation continue to be soft. I'm back right now with Jim Grant. And Jim, we were talking about inflation, why this 2% number is so important to Janet Yellen. And earlier, when I asked you during the commercial break, we're not sure why. What do you think?
Well, she pressed for it years ago when she was a member of the Federal Reserve Board, when she was, I think, president of the San Francisco Federal Reserve Bank. This number is now tacked up on the wall as if it were handed down from on high. 2%, we need 2%.
Right.
Why? We don't know. So 1960 to 1965, 6 years inclusive, there was not one year of those 6 in which the rate of inflation reached 2%. 1 year, I think 1961, it was 70 basis points, 0.7%. So that nowadays that would be the grounds for a kind of a panic, right? My God, deflation, 1930s, knocking the door. So what is it that's changed? Well, for one thing, of course, we are more encumbered, we have more debts, and they think we need some inflation to help us all pay our debts. But they never say that. And I think it's the intellectual dishonesty of this monetary policy approach that most rankles me. I can't stand it.
Well, I mean, it's been easy money for a long time.
It has.
And here we are looking at an economy that, yes, we are out of the throes of the recession, of the financial upset of almost 10 years ago now, but the economy is not doing all that great. I mean, look at GDP. 1.5% on average in the last quarter. You've got tax receipts down. Do you think that there is a risk things slow down as the Fed accelerates this?
Oh, yes. I think there's a big risk. And I think that Janet Yellen, in her testimony this past week and in the document that the Fed issued in late June having to do with their plans for the so-called normalization of the balance sheet, in every occasion, Janet Yellen has issued a PS. PS, if things don't work out, we will be back. We will be back with QE4. We'll be back.
That must make you happy.
Oh, it's delightful.
So, in other words, they're going to be there regardless.
They will be there. So what they're saying, and again, people don't really take the measure of this. What they're saying is that there's no going back, that we are going to issue these dematerialized things we call dollars, these digital things that we type into a computer. The way they create credit is by typing in $ and something into a computer, and that is called a bank reserve, right? They issue dollars, they buy bonds from somebody, and that somebody deposits the proceeds, the dollars, into an account at the Fed. So the Fed, by buying bonds, owns the bonds, now $4.5 trillion, and somebody else, the bank, has an account at the Fed with dollars that didn't exist before. So that is what they call QE.
What about what's going on in the rest of the world? I mean, this past week, Bank of Canada raised interest rates. You've got Europe.
Well, there is the tom-tom beat of the central bankers that they intend to tighten. They intend to step back from these most radical policies of the past 10 years. That is the agenda of these central bankers. Now, whether they do it's another question. But that is what they're talking about. Even Mario Draghi, who has been leading the charge in QE, has been talking about this, much to the alarm of the people who own European securities at prices to deliver yields of less than nothing.
Right, and number of yields within Europe are actually negative. That's what we spoke about this past week when I had on the morning show the chairman of UBS, Axel Weber. Here's what he said about that.
What Europe is doing, it's falling in behind the Federal Reserve that is way ahead in normalizing monetary policy. Interest rates are now above 1%. There's still in negative territory in Europe. The ECB is still augmenting its balance sheet, and the Fed is contemplating reducing it. What the ECB will do is reduce their purchases, but it doesn't mean that the balance sheet will shrink anytime soon.
He basically said, yeah, rates are negative in Europe, but the European Central Bank, things are getting better, and they should be letting up on the stimulus.
They should, but there are consequences for their having suppressed rates. And the president or CEO of Deutsche Bank was on the tape maybe a week ago saying, he said, all this bond buying by the European Central Bank, all the aggressive buying without regard to price or value has served to destroy the method of price discovery by which we decide how to price credit. We don't know how to price credit, said he. Now, that is a soft-spoken but very eloquent and powerful denunciation of what the ECB has been about. When as a banker can't price credit, what does that mean? Well, prices, credit interest rates are the most sensitive, I say the most sensitive prices in capitalism. They define risk, they discount future cash flows, and the central banks have determinedly and with malice aforethought, or with intended benevolence aforethought, have suppressed and manipulated and muscled around these prices for 10 years. And you can't tell me there's no consequence for that.